Unpleasant tax surprises are often symptoms, not the problem itself. One of the most common frustrations we hear from high income families, especially those who are not yet working with us, is surprise tax bills. In many cases, those surprises aren't caused by a single mistake. They're usually a symptom of tax planning that's reactive instead of coordinated. A very common surprise that we see is from capital gains inside of mutual funds. Even when a family hasn't sold anything, the taxable gains can still show up on the return. This often happens when investments are not tax sensitive in their nature and design, when they're maybe held in the wrong type of account, or when they're selected without considering how the gains are distributed. This frustration is less about the tax itself and more about not really seeing it coming. High income families often have multiple income sources that could land at one time. Things like wages or bonuses, business income, investment income, or even one time events like asset sales or business sales. Without coordination, income can unintentionally stack up, pushing families into much higher marginal tax brackets and triggering surtaxes that they were unprepared for. This is especially common in the years leading up to that time of financial independence. Many times, families are surprised by the net investment income tax, a surcharge on their investment income at higher levels of income, Medicare premium charges, and loss of deductions or credits from either the standard deductions or income floors or income ceilings. They're not always intuitive and they're rarely discussed unless someone is looking ahead. Crossing that threshold by even a small amount can have a very outsized tax consequence. Well, for business owners and professionals, these surprises often show up when a business interest is partially sold, stock options are exercised, concentrated positions are reduced, or other types of activity inside of a business that moves out to the business owner. So, without proactive planning, these events are often treated as tax outcomes instead of tax decisions. The difference is whether they're evaluated before the return is filed or after the bill arrives. Determining how to pay your taxes is not tax planning. Tax surprises are rarely about doing something wrong, but they're usually about missing the coordination that helps make the outcome a little better. We found that a comprehensive financial plan can help shift taxes from something that you react to into something that you plan for and plan around to optimize. It doesn't mean that eliminating taxes is an option. I wish, but it does mean fewer surprises and more intentional decisions. Tax surprises are usually symptoms of planning that didn't happen early enough. At Covenant Wealth Management, we approach planning through the lens of financial independence, helping families steward what they've built so work becomes optional and decisions stay intentional over time.